Hi folks, welcome to this video on a longer problem from chapter 5. This one involves two companies, Palm and Storm, Palm being the parent and Storm being the sub. And in this case, we have to go through all of the steps to prepare consolidated statements several years after they become related. So, in our case, first thing we would do in any of these questions is we would calculate the acquisition differential, goodwill, and our NCI, our non-controlling interest at acquisition. So if we look at the data in our question, we know that Palm paid $350,000 to buy 80% of the outstanding voting or ordinary shares, also known as common shares of Storm. They would have paid, or the implied value of 100%, if they had bought 100% of the outstanding voting shares, they would have paid $437.5. So, but that, we have to remember, that is the fair value of what they control. So even though they only own 80% of the outstanding voting shares, they still control 100% of the fair value of the company, which is $437.5. So what did they get to get that control? Well, they got the common or ordinary shares and retained earnings of the sub at the date the two companies became related. And you can get this information here right from the question. So if we go to the problem itself at the very beginning, we know that at the date they became related, which is December 31st, year 2, Storm purchased 240,000 or had ordinary shares of 240,000 and retained earnings of 64,000. So you'll notice we don't have the separate entity balance sheets at that date, so we can still use the shareholders' equity of the sub at the date they became related to get the net identifiable assets that Palm now controls at acquisition date. And those two amounts total to $304,000. So the difference between the implied value and the carrying value of the net assets that are under Palm's control of Storm at the date they were acquired, the difference between those two is the acquisition differential of $133.5. From that acquisition differential, we're going to start to allocate it to what? Any of the fair value increments and decrements assessed by the parent. And we know that the plant assets had a fair value in excess of carrying value of $44,000, and trademarks were something that that Storm, the sub, had, but the sub had them valued at $0. Palm, the parent, thought they were valued at $36,000, so there's a $36,000 increment. So in total, you were able to allocate $80,000 of that $133,500. So what we couldn't allocate of the acquisition differential is now goodwill. So to calculate the NCI, which is what we would also calculate at acquisition, because we're using the entity theory, and we know that because they didn't tell us otherwise. Remember, we've always said that unless you're told otherwise, assume that the parent is using the entity theory to value its NCI. We take the implied value, which is $437.5, multiplied by 20%, and we're going to get $87,500 as our NCI. Now, in most questions, it may not ask, but I usually ask you to do the acquisition eliminating entry on the consolidation worksheet at acquisition, which does what? Sets up on that third set of books any of the fair value increments, because don't forget, on the consolidated books, they have to amortize those things. So you're going to pick up the NCI as well on the consolidated balance sheet, as well as the plant assets, the trademarks, and any goodwill that was calculated, which we found is $53,500. Don't forget, we want to avoid double counting. Okay, so we only want to pick up the ordinary shares of the parent, because don't forget, we're doing consolidated statements for the parent, and the parent shareholders only want to see the ordinary shares and the retained earnings of the parent at acquisition. They don't want to see the retained earnings and the ordinary shares of the sub. We also want to eliminate the investment in the sub, again, to avoid double counting. Why? Because don't forget, we are picking up all of the carrying value plus the fair value increments of all of the assets and liabilities of the sub at the acquisition date. The carrying value plus those fair value increments are exactly what the investment account's about. So we don't want to double count, so we'll eliminate the investment in the sub at the acquisition date, which is $350,000. Our second step here that we're going to do is to prepare a schedule of the of amortized acquisition differential and impairment losses from the date we became related all the way up to the current year, the end of year 6. So you'll notice here that in the question, they said that the plant assets, any increments, are going to be amortized over 8 years, which means on the consolidated books, we're going to record extra depreciation, okay, for the plant assets of $5,500 a year. That's $44,000 divided by 8. For the trademarks, we're going to record any amortization of the intangible asset increments on the consolidated books at $36,000. That's the additional amortization that has to be taken over a 12-year period. So $36,000 divided by 12 is going to give us $3,000 a year, right? So since the date we became related, which was the end of year 2 to the end of year 5, we would have amortized for trademarks an additional $3,000 a year for those 3 years. That's year 3, 4, and 5. Now remember, no separate entity, neither the parent nor the sub, are booking that separate entity on their separate entity statements. So these are amounts that are going to appear on the consolidated statements. We've just got it accumulated over the 3-year period, right? Why? Because anything that's going to be amortized or that's been amortized over the 3-year period from years 3, 4, and 5 is going to help us to adjust our retained earnings to the end of year 5. And we have to do that if we wanted to calculate the opening balance of consolidated retained earnings at year 6 or at the end of year 5, right? So what we're going to do is we're going to do a full set of amortizations that take us up to the end of the previous year, but also amortizations in the current year, year 6. So we know that up to the end of year 5, we would have amortized $5,500 a year times 3 years, years 3, 4, and 5, to give us $16,500 amortized to the end of year 5 of that $44,000, and of the $36,000 for the trademarks, we would have amortized $3,000 a year for 3 years. And that means that in total, from the date we became related to the end of year 5, we would have amortized $25,500. In year 6, we would have amortized $8,500. $5,500, which represents 1 year of amortization for plant assets and 1 year of amortization of trademarks. That's your $8,500. Now you'll notice I separated out a column for the loss during year 6. Technically, you don't have to separate that out, but the reason I did was because in our question, we know that any losses that we book in year 6, that is, any impairment losses, are going to be set up to a different account than any amortizations. We know that from our question because our question tells us, if we go down here, it says that amortization expense is reported in selling expense, while any of the impairment losses are going to be in other expenses. So I just opted to separate them out here in the table, so I know exactly how much is going to one expense account in the consolidated income statement for year 6 and how much is going to a different expense account in the consolidated income statement for year 6. So now, once I do my calculations here for amortizations including impairment losses, I can see now that at the end of year 6, I would have left to amortize at the end of year 6, so into years 7, 8, 9, and 10, right? $22,000. I would also have amortized to the end of year 12 what's left. By the time I finish up to year 6, I would have to amortize this remaining $14,350 for the remaining years. Don't forget, so far, I've only amortized years 3, 4, 5, and 6. So I would have to be amortizing $14,350 for remaining 8 years for the trademark because I've already just amortized, okay, including impairment losses. I've already amortized and recorded impairment losses, okay, for 4 years. That's year 3, 4, 5, and 6. So this 14,350 would be what's remaining to be amortized over the remaining 8 years. This again is 4 years because in total it was 8 years, and I've already carried out 4 years here. And goodwill, again, I'll have to keep testing it for impairment, but what's left is 50,000. So the balance of what I haven't yet amortized or tested for impairment loss is 86,350. So that's what's left of this 133.5. All right. So that's going to be important. Why? Because this is going to adjust any of my retained earnings, okay, before the end of year 5. This is going to be adjusting the sub's income, 8,500 plus 13,150, when I calculate my consolidated net income for year 6. And this, when I calculate NCI in the balance sheet, if I use method 1, NCI is going to get its cut of what's unamortized and unimpaired to date. It's going to get its share of the remaining fair value increments and decrements, right? Which include 86,350. So, if I go on now to step 3, I have to calculate my consolidated net income. So you can see I'm going to take the income of the parent, which sits on the separate entity statements. If I go back to the question here at 108 here, and 62,000, right? So the parent separate entity income is 108,000. Storm's separate entity income for year 6 is 62,000, right? You'll notice here in the question that we have, when our calculation of dividend income, the parent took in or included in that 108,000 is 19,200 in dividend income from the sub. How do we know? The question tells us that. They told us that during the year, Storm declared a dividend of 24,000. Well, don't forget, the parent owns 80% of the outstanding voting shares of Storm, so they're entitled to 80% of that as a dividend. So, if we now look at our question here, got too many windows open here. So you'll notice here again that in that 108,000 is 19,200 in dividend. Well, it's because it's intercompany, we have to remove it. So we only have 88,800 left. We've already established that Storm's profit was 62,000, but we have to deduct from that any of the amortizations and the impairment losses that also occurred during year 6. Don't forget, it's because of our relationship with the sub that we have them in the first place. So we adjust these amounts to the sub's income, and we have adjusted income of the sub of 40,350. So our consolidated net income would be the adjusted income of the parent plus the adjusted income of the sub, and that gives us 129,150. So we can calculate the attribution to P shareholders and NCI to allocate that income in one of two ways. The easiest way to do it would be to allocate the sub's adjusted income to NCI first, because the NCI shareholders are shareholders in the sub, and get 8,070. So to get 129,150, we would know that the remainder of what didn't get allocated to the NCI gets allocated to the parent shareholders, and that's $121,080. Or we can calculate it this way. Parent is 100% shareholder, parent shareholders are 100% invested in the parent, so they get the full amount, the full allocation of the adjusted income of the parent, but they are only 80% shareholders in the sub, so they get 80% of the sub's adjusted income. So if we did that math, we'd still get 121,080. Now we have to prepare the consolidated income statement for year 6. So to do this, we know that consolidation is additive. So we're going to take the sales of the parent and add to it the sales of the sub and get 1,465,000. Interest income, that would be interest in any interest and your dividend income. Income, right? Would be what? Well, if we did this math, we've got 38,000 in the parent, plus 6,000 in the sub, But don't forget this 38,000 includes the intercompany dividend of 19,200. So when we make that adjustment, we're going to get 24,800 as the interest and dividend income left. I think in the solution initially they removed the dividend income reference because they realized that the entire amount of the dividend income was going to be removed. But in fact, to stay true to the question, that is the account name, including the dividend income. So now we're going to have total revenue of 1,489,800. Our cost of goods sold is that of the parent, adding to it that of the sub, which is 1,038,000. Now notice in the selling expenses we have to include what was amortized during the year. So we take the parents plus the subs plus what we amortized during the year. Don't forget we're doing this for the consolidated books. Nobody is booking, neither the parent nor the sub is booking those separate entity fair value increments or those fair value increments. Neither of the separate entities are booking it. So it has to be booked in the consolidated statements for the year. And that's 8,500 in total. Notice in the other expenses, that's where the impairment losses are being booked to. So now we've got 13,150. So in total, we've got expenses of 1,366,650. So if we take the 1,489,800 and deduct from it the 1,366,650, we're going to get 129,150. The attribution we can take from the previous step, and we can see it's fully attributed. Now let's calculate the ending balance of retained earnings at December 31st, year 6. That would be our next logical step. Why? Because we need to prepare the consolidated balance sheet for POM. So in order to do that, we're going to need to calculate some retained earnings, some income balance sheet account amounts, and that would be the retained earnings and the NCI. So let's go back to the separate entity statements where we're going to find that the retained earnings of POM at the end of year 6 are 150, and at the end of year 6 for Storm, the retained earnings are 190. Let's go back to the statements to make sure you know where to find that. Right? Go right here for Storm's retained earnings 190 and POM's at 150. All right. So now if we go back to our problem or a solution, I should say, we know that the acquisition retained earnings were earnings that were earned by the sub, but they were earned before we became related. So we can't lay claim to that at this time. So we can calculate the post-acquisition retained earnings of the sub at 126,000. But we have to adjust it for the cumulative acquisition differential, amortizations, and impairment losses. That's what I was trying to say earlier here. We have to adjust it for our 25,500 plus any adjustments that we made in year 6. All right. So cumulatively, we adjusted before up to the end of year 5, 25,500 plus what we adjusted to income in year 6, which gets closed out to retained earnings from a consolidated perspective, right? So these three numbers, if we were to add them together, would be what we have down here, which is 47,150. The other way to see this is if you look at the difference between the acquisition differential you started with and what you have not yet amortized of that acquisition differential. The 133.5 less what you haven't yet amortized is going to give you everything that you amortized up to and including the end of year 6, which is the amount by which we would adjust the retained earnings of the sub as well. So if we go down here now, back to our step, that's 47,150. So you kind of have to envision here that every year that we were calculating consolidated retained earnings for consolidated balance sheet for year 4 and year 5, we would have already been adjusting, okay, any of the previous year's income statement adjustments from a consolidated perspective to the retained earnings of the sub. This year, all we're doing is catching it up to the end of year 6 because we want to calculate retained earnings to the end of year 6. So if we have this number now, we see that our amount now, the amount that we would have now, and our post-acquisition adjusted retained earnings, right, is $78,850. That's for the sub. So we can only lay claim to our share because we are only 80% investors in the sub. So we can only lay claim to 80% of the post-acquisition, meaning after acquisition, adjusted retained earnings of the sub. And that's 80% of 78,850, and that gives us 63,080. So we know that on the consolidated balance sheet, we're going to have $213,080 in consolidated retained earnings. Bear in mind that the other 20% of this, or $15,770, is going to belong to the NCI shareholders. And for those of you who might prefer to use method 2 to calculate NCI, you might want to use that allocation to NCI in order to calculate your ending balance in the NCI account. That's going to be on the consolidated balance sheet at the end of year 6. And speaking of NCI, that's our next calculation. And again, you can use either method 1 or method 2. Some students prefer to use method 1, which means that the NCI is going to get allocated at any point in time the book value of the sub at the date for which we're calculating NCI, which is the end of year 6, plus any unamortized acquisition differential, and we can get that from step 2. We can get the book value of S if we look at the year 6 statement. So let's go to the Storms statements at the end of year 6. You can see that its ordinary or common shares and its retained earnings are given to you here. And you can see those numbers total $430,000. So those are the numbers that we've used here in our statement, right? $430,000, all right? Plus the $86,350. You remember we got that right back here from step 2, right? Because that's NCI gets their cut of that, because NCI gets their share of the fair value, and that's what it is, or of what's remaining to be amortized, plus the book value of the sub because they are shareholders in the sub. So if we do that math here, whoops, forgot the multiplication, we're going to get 103,270. If you prefer to use method 2, as I said just a few minutes ago, you might prefer to take the opening balance of NCI and calculate it like any other balance sheet amount. You can build it up because balance sheet accounts never close. So we can take the opening balance of NCI, which we calculated in step 1, plus NCI's share of the post-acquisition adjusted retained earnings of the sub, which we could use our data from step 5 to calculate. So 78,850 times 20% is going to be 15,770. So if we added those two together, we'd get the same value for NCI as we got under method 1, 103,270. So now it would be appropriate for us to prepare the consolidated balance sheet. So now what we have here is we have the plant assets, which are the parents, 270, plus the subs, 200, plus what we haven't yet amortized of the fair value increment, which is 22,000. So we get 492,000. Don't forget the value of the trademarks and the value of the goodwill we can get directly from step 2. Those are the recoverable amounts, or what yet hasn't been tested for impairment, or in the case of trademarks, tested for impairment or yet amortized. And that's 14,350, plus your amount for goodwill here is 50,000. So now if we go back to the consolidated balance sheet, we'll see here we've got investments, 86,000 plus 26,000. Those are current assets. We've got our notes receivable, which is 14,000. Don't forget, that's only held by one of the entities. Inventory we can see is 140,000 plus 220. That's the parents plus the subs. Accounts receivable, parent plus sub. We already have that number here. And cash, parent plus sub. And we get 58,000. Notice here in this consolidated statement of financial position or balance sheet, we don't show the investment in the subsidiary. Why? Because don't forget, at acquisition, we divided or allocated that out. That's already been allocated out. We didn't pick up any common shares or retained earnings of the sub, and don't forget we picked up the increments, including the goodwill. So the fair value of the carrying value plus the fair value increments, the carrying value of the sub plus the fair value increments that we picked up, including goodwill, okay, replace in essence the investment account. And again, we also have our share of the NCI, or the NCI share of the fair value, listed there as well. So don't forget, the investment in the sub has been eliminated as a result of doing this acquisition eliminating entry. So it's not going to appear here on the consolidated balance sheet. So what do we have? You'll notice here in the equity section and liabilities, we have the ordinary shares and the retained earnings. Notice here that it's only the ordinary or common shares of the parent. We can see this if we have a look at the problem. We're only picking up the ordinary shares of the parent, right? And we are only picking up what we calculated in retained earnings from step 5. And notice that does not include any of the retained earnings at acquisition, right? So we're only picking up our retained earnings being the parents, plus our share of the post-acquisition adjusted retained earnings, which does not include any of the retained earnings that we eliminated earlier on. So again, we're picking up $213,080 on the consolidated balance sheet. So we've got that right here. We're picking up the NCI that we calculated in step 6. We're picking up the parent and the subs note payable, the current liabilities of the parent plus the subs, and the accounts payable of the parent plus the subs. And you can see that when we do that, we're going to get a balance sheet that balances. In our next video, we'll show you how to calculate the balance in the investment in the sub, assuming that the parent used the equity method on its separate entity statements to record its investment in the sub. And then we'll also do a consolidated statement of changes in equity for year 6. So I should put the word consolidated. Statement of changes in equity for year 6. So I hope you found this video somewhat helpful to you. And now we'll move on to the second one.